Hi, I'm Matt Ingram from Bloomberg Intelligence in Sydney. I'm joined by Jack Baxter, our real estate analyst, to talk about the outlook for the second half in Australian equities. The first half of the year was tumultuous to say the least. Huge hikes from the Reserve Bank of Australia and other central banks, and also those collapses of banks across Europe and the United States. So how are things positioned? Well, firstly for banks, we think the outlook is generally darker. They are going to benefit from further hikes from the RBA and other central banks, but there's a huge wave of competition coming through, particularly in home lending, that might offset these gains. There's going to be a worsening of credit, not a collapse, but we're certainly going to see an uptick in impairments, and loan growth is likely to slow. So those big profit gains that we saw in the first half of the year are going to moderate. We think the big winners across financials are going to be insurance. Their profit's going to see a 50 to 100% uplift, due largely to increases in investment income on the back of those central bank hikes globally. Speaking of central bank hikes, Jack, there's a lot of bearishness in the market about property, rents and the general outlook. What are your thoughts on rents for Australian commercial real estate in the second half?
Look, perhaps we start at the best and work our way through to the worst. So right now the industrial space is very tightly occupied, and we do see that continuing over the next 12 months. So rent growth in that space could be really strong. In fact, so strong that prices aren't keeping up. So our expectation is still for cap rate expansion. Working down the list, retail. You talked about cost of living and sort of rates feeding into that cost of living element. We do expect the outlook for retail property to soften, but for the time being, it's still relatively strong, and there are flows from very high CPI last year, which does, obviously for the peers with CPI-linked rental increases, will boost them. However, the other peers still have pretty high fixed increases. And then bottom of the list, I should say, is office. We have seen some pretty tough market conditions for office. We do see incentives starting to creep up in that space, and that really reflects the flight to quality we're seeing in the market. High quality tenants are looking for high quality assets, and we have seen those lower quality, grade A or below, be hit quite hard. And GPT was one recently that got hit pretty hard on the vacancy space after losing a key tenant. But speaking of property valuation in Australia, I'm curious to hear from your end around the banking space and how that hits the banks.
Thanks, Jack. Well, look, obviously coming into a downturn, the market's concerned about credit quality, and commercial real estate is generally the pointy end of that. Honestly, we're pretty sanguine about the outlook. Yes, vacancies are low across the sector, as you said. There are some problems creeping in around the edges, but I think that alone is keeping the banks relatively confident. The exposure is less than 10% of total book for all of the big four banks. It's much higher for Bank of Queensland and Judo Bank. The really pointy end of that is those central city retail, and that's a very low proportion of their books. And so in terms of exposure to those problem areas, again, the bank's exposure is very low. Provision coverage is lower than you'd like. It's below 30% for all of the banks. I think that's probably recognition of the quality of the assets. They're not going down the quality spectrum too far at this stage. So look, generally speaking, we think credit's pretty benign heading into the second half. That might be more of a 2024 story, if at all. But look, I think a combination of both the bank's outlook, the real estate outlook, definitely darker in the second half. The bright spot looks like it's insurance, not only from investment income. The two big insurers in Australia, Suncorp and IAG, also look like paying fairly big dividends in the second half on the back of special capital management. We certainly hope it's going to be a quieter second half, and we hope it's a very profitable one for you.